Hello and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today we wanted to get into a real life scenario. Thank you so much, Shannon, for putting up the numbers and making sure that you reached out and you wanted help. So thank you for that. We're going to go ahead and help you right now. And before we do that, before we hop into how we're going to be paying off Sharon's mortgage, paying off Sharon's loans, I want you to like, share, and subscribe so that everyone around the world can know how powerful velocity banking is. Folks, are you ready? I want to climb right into this. Now, before you do anything with your finances, it's very imperative, and you got to write this down. It's imperative that you get an overview first. That means you know how much is coming in, you know how much is going out, and that you know the status of your debt obligations, loans, lines. Let's go ahead and make sure we gather all of that, okay? The next thing you need to do is go ahead and make sure that you are annotating it down, all right? So I've already done it. You don't need to do that, Shannon. We got everything that you placed on that form, and we really appreciate you for it. Now, $83,000, all right, is what's left on the mortgage. $747, the minimum monthly payment there. It's at a 7% interest rate. And she does have some loans, but they're very small, right? And so $1,769, the balance on one loan. Of course, there is a balance of $296 on the other loan. And you see how much she's paying on the minimum monthly payments. We're going to go ahead and change that up. Now, $10,000 on her lines of credit. This is a personal line of credit. Way to go, Shannon. Look at your lines of credit. You got 3, okay? And we always recommend 3 to 5 lines of credit. That way you don't overbear yourself, okay? You're not taking on too much. Or as they say in the South, or as my folks say, your eyes aren't getting too big for your stomach. Now, $10,000, 0 balance, 0 monthly payment. You know that we're going to have to use one of these lines of credit to make sure that these loans go away real fast. And we're going to show you that, all right? So we have another line of credit. $10,000 is the limit. $419 is the balance, and $30 minimum monthly payment on one line of credit. And then the other one is $10,300. That's the limit. And there's $700 balance there, as well as a $30 minimum monthly payment. Now, what are we going to do first? Well, what I'd like to do, Shannon, is I'd like to go ahead and make sure that these balances are 0, all right? Make sure that these balances are zeroed out. That way you have the velocity banking tool working to your greatest strengths. Because when all of those are 0 balance, that means you can have all of this credit, okay, to use against your enemy, the one-way loan, all right? Now, let's look at it and see what else we need. What else do we need in order to pay down these loans? So we have the weapons right here, the lines of credit, okay, as well as her checking account, as well as her IRA, 401k, whatever you have, right? We already have the weapons. Now, what else do we need? We need the cash flow, all right? So she is generating $1,000 each and every month in cash flow. All that means is the greater the cash flow, the faster the debt pay down. And this is what I want you to understand. Because you're going to be using the lines of credit to pay this down, there could be a temptation in your mind to say, wait a minute, those are 2 debts. Why would I want to stack a debt on top of a debt? And this is why. Because this, when you're using it correctly, is not a debt. This is an open-ended line of credit. While on this side, it's closed-ended loan, meaning you're only going to put your money one way, and that's to the other person. That's to the lender. That's to the bank, not you. Whereas with the loan, you can pay, then borrow, and then pay, and then borrow. So this is cyclical. This is a revolving account, all right? So what you're going to do is you're going to put a certain amount Okay, whether you are comfortable with 5,000 or whether you are comfortable with 10,000 is going to be up to you. But may I just share with you this mathematical concept, all right? That if you were to put $10,000, let's say, on the line of credit to smash this loan, now I'm going to share with you that you shouldn't do that, okay? And I'll share with you why in just a little bit. Now, $10,000, but we have $1,000 in cash flow, right? You're going to be using your personal line of credit as your new checking account, meaning you're going to be spending from this, and you're also going to be putting your checking account, your income, right? So the income hits your checking account. Then what you'll do is you'll place that income inside of your line of credit that you're going to be using, okay? The $10,000. Why? Because now you have a balance of $10,000 because you just chunked your mortgage principal. Does that make sense? Okay, so now you're going to have a $10,000 balance. So we're going to go ahead and just give you a visual here. Now it's $10,000. Okay, instead of zero balance, now you have $10,000 balance. Okay, let you look at it. Now, what we're going to do underneath here is we're going to place your cash flow here. Now, why did we do that? Because we want to see how long it's going to take us to get rid of this debt of $10,000. Remember? Let's get rid of that balance. So how long is it going to take us? Let's see. All right. We'll go ahead and cross out the zeros here, cross out the zeros here. Here it's telling us it's going to take us 10 months to get rid of this debt. Now, remember, you're not adding another job. You're not taking down your expenses. You're not doing anything except moving your money the right way so that it can work for you instead of against you. Because as you get rid of the principal on these loans, guess what else you're getting rid of? The interest. You are becoming an interest cancellation specialist. And that interest is going where? It's going back to you. That's adding to more and more of your cash flow instead of their cash flow. Now, I promised that I was going to come back to why you should not put that $10,000 towards this mortgage balance. Do you know why? Let's share with you why, okay? Remember the cash flow index number that I was telling you about? How that if it's 0 to 50, you should get rid of that loan as soon as possible. Or how that it's 51 to 99, you should be restructuring the loan. Or if you have 100 and above, it's a freedom zone. That means you don't have to worry about paying that loan off quickly at all, okay? Pay the loan off, but just not as quickly. Mortgages usually are between 100 and above, okay? 100 and above is usually where mortgages sit, and I can tell just by looking at it that this mortgage is going to sit at a 100 and above, all right? And so that's why you don't want to place this much capital towards that mortgage. You would be better off eliminating these balances and capturing these cash flow numbers, all right? Eliminate that. Yeah, and look, you can even do it on one of these balances. Since you're so good, Shannon, at making sure that you have the low balances on your lines of credit, let's go ahead and knock these balances out. Knock them out, okay, with that personal line of credit. That way, this cash flow comes to you instead of to them. Now, you stated that you had a cash flow of $1,000, but if you eliminate that over $1,700 of loans that you have, this cash flow would then come to you. So we have 94, then we have 62. We're just going to add it up old school. Is that all right? 5, right? 1. So now you have $1,156, all of which can go towards paying off this line of credit, this loan. Perhaps you want to get another loan. Perhaps you want to get a car. You can do that. Okay, now that you know how to operate efficiently. Now remember, how do you calculate the CFI, the cash flow index? Okay, it was actually created by a rocket scientist turned financial guru, so he knows what he's talking about. Shout out to Dale Clark, all right? This is how you do it. Loan balance, let's see, loan balance divided by your minimum monthly payment, and that's going to equal your CFI, or your cash flow indication. Meaning you're going to put your loans through here, however many loans that you get. And remember, loans are supposed to be used for building assets so that your assets can pay for your bills. Loans and lines are mainly used so that you can purchase assets or invest in assets so that your assets can pay your bills. All right? Once you do that and put it through that cash flow indicator, you can know what your priority loan is and what loan you can basically leave until however long. Now, if you want to pay it off quickly, of course you can do that because you have the tools to do that as well. Now, Shannon, I'm going to be honest, I still got a lot more to show you. And I would like to give you a presentation that I believe will blow your mind, because I'll give you your debt-free date. All right? And that's for anyone on here as well. I can give you your debt-free date, and I can do it for free. Now, CJ, that's a new offer. You've never done that. I know. I'm giving you your debt-free date for free. All you got to do is go ahead and make sure that you fill out, right, your JOT form, okay, your velocity banking worksheet, and know that I need your email, right? We can contact each other. I can give you your debt-free date. You'll even have a customized video made just for you. All right? Awesome. Boy, we got a whole bunch. I mean, we have a bundle that just came out as well. So if you need help with investing, we got you. If you need help on your personal finance side, we got you, right? Listen, folks, I know you think that maybe cryptocurrency is a fallacy, but it's not, because people are making money with it, all right? I've made money with it. I'm making money with it. You understand? Because there are no bad investments, just bad investment advice. Because the truth of the matter is, the truth of the matter is, people are making money everywhere. When the market is up, when the market is down, when the market is sideways. Why? Because they know how. And now, as far as velocity banking goes, you know how. Let me know if you have any questions. God bless you. Have a great night, and we'll see you in the other video.